Thank you for the introduction, Fred. I must say I'm glad that the code word is Charlie. When I gave the keynote speech at the IASB, it was crap. And I think I like Charlie better. So you will hear from Charlie and Oscar next. So hello, everyone. It's great to see so many faces here in the room. And obviously also being aware of people joining online. We have a great event here, and I hope you will find something on our agenda. Before I start, I will ask the audience here in London a question. How many of you have seen the film that won 7 awards at this year's Oscar, being Everything, Everywhere, All at Once? Can I see a show of hands? We might actually ask the conference organizer to arrange for another breakout session where we could see that movie. Well, it's decent. So if you haven't seen that, it's at some level about the filing of a tax return. You may think that's a 10 years link to financial reporting, but bear with me. The surreal film crosses universes, and the lead character is trying hard to juggle completing her tax advice and an aggressive tax auditor with multiple challenges in her private life and in the multiverse. Maybe one reason why that film is so acclaimed is that the chaos and challenges resonate with us. We live in uncertain times with a lot of risk and a lot of scrutiny. And just like the movie character, we make decisions every day, decisions that will define who we are in the future. For companies, investors, auditors and regulators, the current uncertainties and the risks associated with them come in many flavors. Geopolitical, technological, regulatory, market-related, interest rate-related, climate-related, and supply chain-related, you name it. Economic uncertainty surrounds us. To illustrate, here's some recent article news headlines, and I quote, "Business and markets rattled by uncertainty. European markets in red as uncertainty looms. And economic uncertainty is on the rise." The last meeting of the Financial Stability Board, where the IASB is a participant, included discussions about yet another uncertainty, that is, possible implications to financial stability from recent developments in the banking sector. Uncertainty affects us all. When conditions change, the need for information you can rely on increases. Useful and trustworthy information enables us to make informed decisions. The IFRS Foundation and its 2 standard-setting boards are founded on the belief that better information results in better economic decisions in general and better investment decisions in particular. Our purpose is to serve the public interest by developing standards that give investors the information they need about companies to help them decide where and how to allocate capital. We at the IASB have more than 10 decades worth of evidence on the benefits of widespread adoption of IFRS accounting standards. Our standards provide a trusted framework to help companies connect and communicate important information to investors amid uncertainty. At the IFRS Foundation, we are fully aware of the current backdrop to companies' operations. We recognize that you and your colleagues face many demands on your time. You're juggling all the challenges related to running your companies. In addition, you must cope with new accounting requirements. And you must get ready to apply new sustainability disclosure requirements. And if that wasn't enough, you also will have to respond to other new regulatory developments. We understand that some companies currently may feel overwhelmed. While we can't relieve you of the uncertainty you may experience, we are doing what we can to help you manage it. We do that while we continuously work to bring about transparency, accountability, and trust, and thereby improve the efficiency of capital markets. As I said, our job is to serve the public interest. That is why we work hard to consider a range of perspectives and to understand the different environments in which both companies and investors operate. We carefully monitor developments, we scan the horizon, we talk to regulators, companies, investors, and auditors. Our steady dialogue with all the other actors in the financial ecosystem informs our work and our decisions. It informs how we prioritize our projects and how best to address uncertainties. We design our standards to meet the needs of our stakeholders, but more important, we design our standards with our stakeholders. We find compromise without compromising on quality. Engaging with and listening to stakeholders, including through public consultation, underpins our standard setting. Let me demonstrate how we at the IASB help by giving 3 examples. First, we move urgently when we need to do so. A recent example is the amendments to our requirements for accounting for taxes in the financial statements. The Organization for Economic Cooperation and Development, the OECD, recently reformed the international tax regime by introducing new cross-border corporate tax model rules. The rules include a global minimum tax, which may increase the amount of tax companies pay. The OECD reform has a knock-on effect on the way companies account for deferred taxes in their financial statements. And because some jurisdictions were quick to enact the reform, we had an urgent demand for us to help companies with their reporting. We've amended our standards to improve temporary reliefs for companies, making it easier for them to account for deferred taxes stemming from the new OECD requirements. By doing so, we've provided certainty for companies. At the same time, it is important for investors to understand how the tax reform will affect companies. And companies need to be able to tell their story to the investor community. We are therefore requiring some new disclosures in the notes to the financial statements. We always consult the public through a transparent process, our due process, before we introduce new standards or make changes to our standards. Our stakeholders gave us useful feedback during our consultation on the proposed amendments to the deferred tax accounting requirements. The feedback helped us refine our proposals and hopefully made it better. The outcome is revised requirements that benefit both investors and companies. Standard setting is always a balancing act. We act as the convener of different views to find the best solution possible, one that meets the information needs of investors without undue cost and complexity to companies preparing their financial statements. Let me give you a second example. We focus our resources on the projects that we rank most important based on stakeholder feedback. Last year at this conference, I spoke to you about our agenda consultation that was then about to close. The feedback to that consultation helped us create our work plan for the current 5-year period until 2026. We carefully considered your views on possible projects and on balancing different priorities. Projects, namely, to put our focus where it really matters, while being mindful of the resources of all those affected by our requirements as well as our own. As a consequence, we were judicious and only added 3 new projects to our work plan, including work on intangibles and the cash flow statement. Those projects are important to investors and will likely affect a lot of companies. However, before we begin work on those 2 projects, we will first complete or at least significantly advance some of the other projects we are already working on. We can't solve all the problems immediately, even when they fall within our remit. So we signal what is coming and what we plan to leave untouched to help you plan. We are also removing uncertainty by making smaller but important improvements to our requirements. Consider our new disclosure requirements for supply chain finance, also known as reverse factoring. Investors were concerned that such finance arrangements were invisible, hindering their analysis. So we are bringing transparency, removing uncertainty for investors. From next year, companies will be required to provide information about the terms and conditions of such arrangements and related liabilities, payment due dates, and liquidity risks. Third, we are helping companies to tell a clear story to the capital markets and to communicate with the investor community. Markets rely on trust. Investors need to trust the markets to trust companies. And trust, in turn, depends on all players communicating transparent and useful information. That is particularly true and important in times of heightened uncertainty. Having well-functioning capital markets matters to us all, and we need to work together to make the markets well-functioning. The markets provide finance to the economy, allocate risk, connect economies, support growth, and contribute to financial stability. Having the confidence and trust of investors is fundamental to ensuring companies can tap into the capital markets for finance at the lowest possible cost. Access to capital, in turn, affects companies' ability to grow and innovate, to do what their business is all about. Because our standards are required in more than 140 jurisdictions, global investors can track and compare financial statements. They trust and rely on the information companies provide about their financial health. The ultimate outcome of financial companies globally using our standards is that investors can compare companies on a like-for-like basis. We know that if investors don't have information, they may assume the worst, and such assumptions increase the cost of capital. Investors appreciate transparency, even when companies tell them the bad stuff. That's why our standards require companies to tell as it is. Now, ensuring companies tell as it is the purpose of our work to improve companies' performance reporting, the Primary Financial Statements Project. The project is expected to result in the birth of a new IFRS accounting standard next year, affecting all companies that report using our standards. The standard will require companies to report operating profit, a measure that really matters to investors who want to know how profitable a company is when you strip away its investing and financing activities. The standard will also allow companies to report some of their own performance measures in the financial statements. Some liken these to an Instagram-filtered presentation of performance. However, for companies, it is important to present their own measures, and for investors, they offer another data point. We will require companies to make the connection clear between those numbers and numbers required by our standards. Or, to continue the Instagram analogy, they need to disclose the filter settings they used to show management's views of performance and how that differs from the standards filter for reporting performance. If companies are using subtotals of income and expenses, such as adjusted operating profit, to communicate with capital market participants, they will be required to disclose and reconcile those management performance measures to the nearest required by our standards. Companies that are making use of such management performance measures may want to start considering already now which measures they use today that will require disclosures in the financial statements. Now, starting to consider now does not mean that the requirement will become effective immediately. The IASB always gives companies time to implement new requirements. That will also be the case for this new standard when it gets issued. We are yet to set the effective date. That's a discussion the IASB has on its agenda for next month, so stay tuned. Let me close. I would like to say again that we are aware of the uncertainties our stakeholders are experiencing, and we try to address them as best as we can. Stormy markets affect everybody. When conditions change, investors need numbers they can trust. IFRS accounting standards can be an anchor in the storm. I think we can all agree that better information enables better decisions. We are collectively and collaboratively developing accounting solutions that improve the ways companies and investors exchange information, improve the way they communicate. Good communication is especially important when dealing with challenges. We are committed to dialogue with our stakeholders. Several IASB members and staff are here today. Come and talk to us. Thank you for listening to me. Enjoy the conference. Thank you very much. Fred, I think we do have time for a few questions. So happy to take any questions before I pass it on to Oscar. Over there is a question. Do we have a microphone? Over here, the front.
Thank you, Yılmaz Arguden from Istanbul, for a wonderful description of the developments. I think all of them are extremely important for trust. One of the key things that IFRS is focusing on is better reporting of performance. However, performance is quite context specific, and it is difficult to benchmark and learn from each other. Another area that we might want to focus on is how we do things, such as the governance of sustainability rather than performance of sustainability. So some KPIs and measures in that area, for example, do you have a sufficiently diverse board? Focusing on and making sure that they are reported could be very useful for the investors as well. So it's not only performance, but also how, and probably governance is the most important thing, and we can have a few KPIs associated with it. Thank you.
Thank you for your question. With all due respect, I would pass that question on to the colleagues on the IASB, given that they are better suited to answer the questions on ESG. But clearly, for all of the performance, I think we are in pretty good shape and have the necessary capacity. Thank you.
Andreas, thank you very much for that fantastic address. I particularly liked everything everywhere all the time. What I wanted to ask you is, you know, the big driver of decisions, particularly capital allocation, is the value you can put on your intangibles, particularly the brands. And is there any moment anywhere in the IFRS sphere which will enable us to actually put brand values onto the financial reports?
Thank you very much for that question. There is room on the IASB agenda. So we decided last year to put a broad project on intangibles onto our research agenda. And that project may actually be broken down in several substrands because we don't want it to be pursued over 20 or 30 years because it could take quite a long time. But arguably, the existing standard that we have seems to be ill-equipped to deal with the new economy, with brands, with patents, with all other things that have been self-generated. Now, whether that necessarily equates to bringing all the intangibles on balance sheet, we will have to consult with our stakeholders. And I know that if we ask that question of investors, there are quite a few that actually would say that frightens the horses if you try to do that. Because that's really our job, that's not your job. Pointing with the fingers at us, right? That's not your job. On the other hand, if we just leave all the intangibles off balance sheet, I think we will be doing ourselves a disservice because we can't see not only the inventory, we also can't see the performance that is coming out of using that inventory. So it's not just a balance sheet thing, but it has a cross-relation into the performance statement. You can't see the build-up, you can't see the usage of that particular inventory in intangibles. And I think that is one of the things that we need to consider. Now, many accounting standard setters around the globe have always shied away from bringing more intangibles onto the balance sheet unless they got acquired. Because the key question was always, how do we measure these intangibles, which often are unique, where we don't have a market? So we are quickly into what we would say is level 3 fair value measurement if we decided to actually measure them at fair value. Or if we retain the cost approach, the question is, does that really show the value? No, it doesn't, because it only shows the cost accumulated that has been spent. Is that a good proxy? Question mark. So it seems that a quicker solution is to think about how we can improve transparency by asking for potentially more disclosures that would inform investors into what are the key value drivers. And if we do that, we want to think very carefully how that information connects then with information that's being provided by our sister board. Because you could define intangibles rather narrowly by thinking into brands and patents and software, But you could also think of it more broadly. If you think about intellectual property, intellectual capital, human capital, social capital, so somewhere there's a turning point where you leave the sphere of financial reporting and turn into sustainability-related financial disclosures. And we want to make sure that these two spheres actually interact and connect with each other. So a long-winded answer to your question, we do have a project on our agenda. We will hopefully start looking into that sometime next year, but really starting would probably, we would only be able to do that from 2025. And the first thing that we will be doing is to define the scope of that project, to then think what we can do.
Andreas, we'll take a question over there, but first off is, on the primary financial statements project, in your keynote, you mentioned stay tuned for decision on implementation date. Maybe you could share something with the audience about what the board will be juggling when the time comes to discuss that.
So, given that this is a so-called big standard or big amendment to a standard, we'll carry a new number, IFRS 18, so get prepared for that. We usually give companies at least 2 years for implementation. So as the plan stands currently, we hope to be publishing that in the first half of 2024, and that would inform you a little bit as to how much time we'll probably give companies. We will have yet to make a decision whether we say it's 2 years, whether it's 3 years. Usually we have rarely gone to 3 years. We have mostly stayed with 2 years. It's too early to really say anything because we haven't really seen the analysis in the papers. But if you say publication in 2024, 2 years onwards, that means it will become effective for years starting in 2027. But that is just to actually show you the timeline as to how this would work out. And we could always obviously allow for early adoption. So if somebody is really eager to apply the standards early on, they would have the potential to do so.
Hi, my name is Noor. Thank you very much for the presentation and the current project which you are telling us. I want to ask about the crypto. So the industry is growing very fast, and this couple of trillion economy now. So we can't ignore it. So the last paper which IASB has issued in 2019 is some staff paper where there are recommendations about intangible asset or inventory depending on the use case. So I just want to know where is IASB now. And yeah, just to just shed some light and give clarity for the industry.
Sure.
Thank you.
So let me first make a slight correction, if I may. That wasn't a staff paper, actually. That was an agenda decision by our interpretations committee. And these agenda decisions actually are being put forward where the interpretations committee comes to the conclusion that a change in the standard is not necessary. The existing literature provides you with an answer. Now, you may not like that answer, which is a different question, but at least there is no gap, so that will be covered, and that led the interpretations committee to decide it's either an intangible or inventory if you're a dealer broker. We will be looking again into the accounting for cryptocurrencies as part of our intangibles project. That seems the logical hook. As I said before, it might still be a few years into the future that we're really dealing with that. So what we are doing continuously is what we call scan the horizon for development. So we are also seeing the uptake in cryptos in the market. However, we haven't seen a sizable number of entities that are using IFRS accounting standards having sizable portions of cryptos on their balance sheet. So that is the evidence that led us to conclude that this is not the project that we should be taking on right now. Right? There are many private investors, that's okay, but they don't use IFRS accounting standards. And companies that apply IFRS accounting standards don't have material balances. So one of the factors that we considered was how prevalent are cryptos and how significant and how material are their balances in companies that use IFRS accounting standards. And the evidence last year was not enough, not widespread. That's not to denounce that there are not jurisdictions for which it may be important, but not on a global scale. So we are currently monitoring, and obviously if there was an uptake, and that situation was changing, we would reconsider that decision and see what needs to be done. One more? Yeah.
Hi there, Nav from Tata Consultancy Services. Thank you so much for hosting us as well. One of the questions I wanted to ask about is when we look at IFRS versus GAAP, and when we think about principle-based versus rules-based, now we see the banks and governments around the world especially moving towards a rules-based order now. Do you see, firstly, number one, alignment or further alignment between IFRS and GAAP to prevent misinterpretation, mispricing, evaluation? And secondly, how a bit more coordination as well globally, well, especially to help the global south as well?
That's a very good question. I think that's probably one of the most difficult decisions that we have to make on an ongoing basis as a board, as to finding the right balance between articulating a principle and giving enough flesh to the bone so that people know what is actually required. And there are differences between different stakeholder groups and between different jurisdictions. So let me give you just one example. We have become aware of a sizable jurisdiction that is contemplating moving over to IFRSs. They have 7,000 companies that would be due to report under IFRS accounting standards. 7,000. If I recall it correctly, that was about the number that was floated when the entirety of Europe went over to IFRSs, right? So that's one jurisdiction. And the jurisdiction has currently a national GAAP system that's completely rules-based. So what that jurisdiction effectively is doing is they're throwing their entire rules-based literature out of the window and are replacing that with beautiful principle-based standards, leaving everyone in the system in limbo. Because they're asking, how on earth do I account for this? There used to be an answer, now there is no answer anywhere. What should I do, right? So arguably, if you're left with that uncertainty, you require more certainty, and one way to achieve that is rules, whether we like it or not. If you are applying IFRS accounting standards and have been doing so for 15 or 20 years, you probably have find a way to how to deal with principle-based standards, and you probably like it, because principle-based standards give you a way to actually accommodate your preferences that you have in your company and in your business, and aligning that with the principal requirements and the standards. So finding the right balance is always a tricky thing. If a jurisdiction, if a sector-specific body wants to give extra guidance, we want to make sure that that guidance obviously isn't in conflict, because sometimes what's called guidance is actually nothing else than a change to our existing requirements, and that is something that we should all try to avoid in order to keep the benefit of there being global standards. But I think your question is spot on. It is a balancing act. Okay, Oscar, ready? All right. So let me hand over to Emmanuel. Thanks very much for your questions and for listening to me. And yeah, Emmanuel, I think you have important news to share. You shared them already, partially. So if you're linked on LinkedIn or on Twitter, you probably have seen what has happened. And if not, I mean, now give my fellow colleague a warm applause. Emmanuel, the floor is yours.